Hi, today we will be discussing about incidence of tax. So let's find out what is the meaning of incidence of indirect tax. So incidence of indirect tax is nothing but it is a kind of tax burden. A tax burden on consumer and on producer. So we'll find out incidence of indirect tax if demand is elastic and incidence of indirect tax if demand is inelastic. So in this video we'll try to find out incidence of indirect tax if demand is elastic. So incidence of tax if demand is elastic. Okay, so for this we have to draw a flatter demand curve. Okay, 0 flatter demand curve, it will be like this, D. So it is a flat demand curve. Why we are drawing flat demand curve? To show demand is elastic. Our supply curve will be normal supply curve. Okay, and we have this quantity. So this axis is a quantity you have to write down, and the y axis shows price. So please mention price in dollar. And this particular point is our equilibrium point, that is the initial equilibrium point, and this is our initial equilibrium price. So this situation, whatever it's there, it is before tax. So we'll write it down. Before tax, what is the situation we have? So before tax we have a situation here. SS is initial supply curve. Okay, and DD, that is a flat demand curve, it is initial demand curve. Initial demand curve. E is our equilibrium point, which is initial, and 0Q is our quantity, and 0P is initial price. So this is also initial price. So please try to mention here 0Q initial quantity. So this is the situation before tax. Now when the government impose indirect taxes, what will be the situation? Supply curve will shift to the left. So supplier or the firm, they supply less, and supply curve shift to the left, this side. So let's see here, after tax the supply curve shifted to the left, S1 and S1. We got a new equilibrium point, E1. Okay, this is after tax. This is Q1. So let's give some value here, quantity. Say example, we'll give here initial quantity 10, initial price 10. Now after tax supply curve shifted to the left. So we have new supply curve S1 and new equilibrium point E1. At E1 we got a new quantity 0Q1. Okay, we'll say some value we will give. Say example, we'll give 7. So quantity has decreased, and the price whatever we have here is price has increased. So we'll give here P1 and say 11. Fine. And this particular point we have a new price P2 because it is intersecting initial supply curve. So we have, okay, this is S1, we have a new price, this is P2, which has decreased. We will say here say 7. Okay, So we'll try to write it down after tax what happened here first. So this is the situation after tax. After tax, immediately what happened? Immediate impact was on supply curve. Supply curve shifted to the left. So we have new supply curve S1, S1. New supply curve, right? New supply curve. And that outside some seller. Okay, don't mind, we'll start here. So S1, S1 is the new supply curve. Let me check which kind of seller. Oh, this is the utensil. They are selling utensils. Okay, fine. So S1 is the new supply curve, and we have E1 is the new equilibrium point. New equilibrium point, and we got a new quantity. 0 Q1 is new quantity, and that is 0 P1. 0 P1 new price. Again we have another price is 0 P2 another price. So this is the situation we have before tax and after tax. Now you can see here easily, like this particular part P2, we'll give some name here, say F and G. Now P2, G, F and P1. Sorry, P, this is 10 value. So P2, G, F and P, these are the tax burden on producer. This is the tax burden on producer. And P, F, E1 and P1, this is the tax burden on consumer. So you can see easily here, the higher portion belongs to producer and the lower portion belongs to consumer. So producer is paying high tax and consumer is paying low tax, but still it's not clear how much. Okay, so we'll try to figure out how much a producer is paying and consumer is paying. Okay, so let's give some differentiation here so that we can easily differentiate. So this dotted okay, this particular portion, that is P, F, E1, P1, that will be the tax paid by the consumer, and we'll give like this. So you can easily understand. So here what we have, first situation, tax paid by producer, okay, is okay, we have P2, G, F and P. So P2, G, F and P, tax paid by producer. And now tax paid by consumer, P, F, E1 and P1. So tax paid by consumer is fine, P, F, E1 and P1. So this is P, F, E1 and P1. So you can see here producer is paying high tax and consumer is paying low tax. So let's figure it out how much. Okay, now let's start. So tax paid by producer. Okay, now see here producer part, you can see this is the producer part, P and P2, this is the producer portion. So what we will see here, P minus P2 into Q1. Fine. So what is the P value here? 10. And what is the P2 value? 7. And quantity we have Q1 7. So here we got 3 into 7, that is 21. Okay, tax paid by producer is 21. Now tax paid by consumer we will find out. tax paid by consumer, okay, or tax burden you can say also, okay. Now tax paid by consumer is here, which is the consumer part, this P and P1, that is 10 and 11. So here what we'll do, P1 minus P. So here it will be P1 minus P into Q1. Okay, so P1 what is the value? 11 and P 10. Q1 we have 7, we're given 7. 11 minus 10, 1 into 7 equal to 7. So tax paid by producer is 21, fine, and tax paid by consumer is 7. So who is paying high tax? If demand is elastic, if demand is flatter, remember producer will be paying high tax and consumer will be paying less tax. So there will be more tax burden on producer and less tax burden on consumer. And now we'll find out, okay, the total tax paid by consumer and producer. Okay, so total tax paid by producer plus consumer. Okay, so let's find out which is the consumer area. The first, this one, this will take P1, and the last P2, because we have to take total. So P1 minus this P2, okay, into Q1, fine. P1 minus P2 into Q1. So what is the P1 value? We have 11 minus P2 value 7, Q1 we have 7. So how much we got? 4 into 7, 28. So total tax paid by producer and consumer together is 28. So total tax burden is how much? 28. Consumer plus producer. You can add this value 21 and 27. You will get 28. So this is the case of when demand is elastic, incidence of tax will be more on producer and less on consumer. This is the video about incidence of indirect tax in case if demand is elastic. Remember, our next video will mention that how much tax consumer or producer will pay if demand is inelastic, like this, steeper. Okay, so we'll try to go to the next video. Okay, and we are going to erase this. We'll stop this video right now, and we'll try to record new video when demand is inelastic. Fine. Okay.